Good morning, class. It's 11 o'clock on the East Coast, and we're getting started here with a very exciting topic, the T-CRUT, an alternative to the Stretch IRA. If you're watching this, you might be pretty bored. But actually, that's not true. If you have a large IRA or if you are inheriting a large IRA, then this could mean hundreds of thousands of dollars to you or your family. So it's an important topic. Let's talk about some disclosures here really quickly. To work here. Just give you a second to read that over. I'll be back in 20 minutes. Just kidding. All right, we're going to talk about the Secure Act and what it did to the Stretch IRA. Was it just essentially killed it? Probably with everything going on, it's hard to remember even last year, but last year in last May, the House passed a Secure Act, overwhelming majority. Senate approved it, and then of course Trump signed into law. So December 20th of 2019 is when the Secure Act became law. And what did the Secure Act cover? Well, it covered a lot of things, but mainly what we call qualified money. So, well, what is qualified money? A lot of people get this confused. Qualified means it's tax qualified. That's not necessarily a good thing, but let's just talk about, first off, what's non-qualified. Non-qualified is just regular savings, regular checking, just cash in your pocket, just normal, what we would call non-qualified stocks and bonds, just a normal brokerage account, and pretty much anything else, anything that's not qualified. Well, what does qualified mean? Well, qualified means that it's something that falls under Section 400 of the internal or the U.S. Code, things like 401k plans, 403b plans, KEO plans, teachers' retirement annuities, thrift savings plans for people who are working for the government, and IRAs, Roth IRAs. All those things are considered qualified because they come under that section. So what we're talking about here mainly is qualified assets. So let's talk about what the Secure Act did and the top 10 results that happened there. Most of them were good. Some of them you may consider were not so good. So the first one is the required minimum distribution age. Some of you may be familiar with this if you were over 70 and a half. And incidentally, you know why we came up with 70 and a half and 59 and a halves and all the halves? Well, because Congress or the House of Representatives wanted 70, the Senate wanted 71. So we'll just settle on 70 and a half. And that makes it so much easier for all of us taxpayers to keep track of that. Finally, somebody got smart and said, hey, let's just move it up to 72. It's a natural number. Let's use that. And also, if you're over 70 and a half and you have earned income, you can still make contributions to a traditional IRA. So that's a good thing. Both of those are good things. Part-time employees will have access now to 401k plans. Obviously a good thing. Penalty-free withdrawals for the birth or adoption of a child up to $5,000, and I think that's probably a good thing. Annuity information and options expanded in the 401ks. Normally 401ks, you just had sort of a litany of different investment options that you have, and maybe you didn't have an annuity option, which gives you a lifetime income guarantee. And I think that's probably, anytime you get expansion, more options in your 401k plan, I think that's a good thing. And then an enhancement of what we call the qualified automatic contribution arrangement. And these are for people who are just starting out kind of in their 401k plans. They just got a new job. They just started their 401k plan. And you want them to contribute. And a lot of them just do not contribute. I mean, you would be shocked at the number of people who are just not contributing. Almost no one's maxing out. A lot of people are, but most people are not maxing out in their contributions. And I meet with people in their 40s, 50s, 60s, and I'm just asking myself, what were you thinking? I mean, you didn't think you would ever retire. I guess they just depended on Social Security and maybe pensions. Number 7, offering retirement credit for people or companies that are offering these plans. So I think that's a good thing. People who are going to school, students who are getting grants, or maybe they're getting scholarships, they're going to be able to use part of that money as considered earned income for purposes of putting money in the IRA. Because I remember when I was in college, that was my most important thing, is making sure that I was putting money in a 401k plan or an IRA, right? And then credit card access to 401k plans. Seriously, I mean, do we really need the ability to get credit cards right out of your 401k? Well, that was never a good idea. So really all of these 9, I think, are good changes. Now here's the one that most people are going to have problems with, and that is the IRA beneficiaries of your IRAs from now on. If it's not your spouse and they're 10 years younger, they're going to have to take that distribution out over a 10-year period. The stretch for lifetime is no longer available. So I want to give you an example of really what that would look like. And the best way to do that is let's look at a case study of what the stretch looked like, and then let's look at that same case study under the new Secure Act. Because remember, for people who died this year or for in the future, the Stretch IRA is no longer available for their beneficiaries. So if you're listening to this, then chances are you're alive. Donald, 80, has $1 million IRA, and he wants to leave it to his son Kiefer. Nice kid. Kiefer, on the other hand, that was 55. He's at the top of his career, and he's also in the top tax bracket, as you can imagine. So here's what the Stretch IRA did for Kiefer and Don. So Don dies. There's the $1 million IRA. Obviously, he has to pay taxes on the IRA as it's coming out every year. He has to start taking distributions immediately, and he has to take them out for the rest of his lifetime. But he can stretch them out for the rest of his lifetime over his life expectancy. And what that allowed is him to keep most of the money still in IRA status, having it deferred, having it grow, and then just paying it out a little by little. The other thing about the RMDs on the Stretch IRA is they got larger as you got older. So the majority of your distributions were happening later in life, which is important because at that time you're retired and your income should be less. Under the Secure Act, of course, what happened was Kiefer's $1 million, he still gets the money, but he has to take it over a period of 10 years. So essentially, if he's 55 and he's working from 55 to 65, well, he's in his highest working years. He's also in his highest taxable years. So clearly what this does has the end result of more taxation. You know, so instead of being able to distribute the money over his entire lifetime like a Stretch IRA would allow, he has to do it over a 10-year period. And usually he's younger, obviously, and his taxes are going to be higher. So those are his highest taxable years. The majority of the payout and the taxes are later in life after he's retired. So his distributions would have been less earlier and more later when his taxes would be less. That's pretty much true. So that's how that works. Let's look at the bottom line here. If you take that $1 million and we look at the current value, and we're just talking very minor, very minimal 3% growth in both cases, and we're using the IRS tables. So at 55, when Don dies, Kiefer's got to start taking it out at age 55, but he gets to stretch it for his entire lifetime, or at least his life expectancy. So there's the total payments. You can see the total taxes, considerably more under the Secure Act. So at age 85, at Kiefer's age 85, under the Secure Act, there's nothing left in the IRA. Under the Stretch IRA, he still had $288,000 left in there. So with $1 million at age 85 in total payments after taxes, and another $288,000 still in IRA status, if he didn't die at 85, he lived on to be 100, he would continue to take all that money out. So you can see that the Stretch IRA was considerably better than where we're left with now, which is the Secure Act. You can see that. So let's talk about a possible solution. So here is one possible solution, and it was a solution that's been around for a long, long time. It just was never as good as the Stretch. Of course, now the Stretch is no longer available, so this is now back in favor. Essentially, instead of leaving the IRA to your kids or your beneficiaries, you leave it to a tax-exempt trust. Right? No brainer, right? Why didn't I think of this? So I leave my $1 million IRA to the tax-exempt trust, and instead I just make the beneficiaries that I love the beneficiaries of the charitable trust, right? So this is a charitable trust, and there is a charitable component, and I'll explain that in a second. But essentially now we can have Kiefer be the beneficiary of the charitable trust. So here we are, Don, $1 million IRA. There's Kiefer, nice guy. And there's that tax-exempt trust with Don's $1 million IRA in it. So The tax-exempt trust pays no taxes, tax-exempt. So that whole $1 million IRA stays in the trust, and it's there to be paid out then to Kiefer. And it can go for Kiefer's lifetime. And we can also even add Kiefer's family members to it, depending if circumstances are right. Normally, we could just say we're going to pay 7% out of the T-CRUT to Kiefer for his entire lifetime. Now, that's taxable. We can't get around the taxes, right? So that's just going to be taxable. The Stretch IRA was taxable too, so there was no way around that. All this allows us to do really is stretch those payments. Instead of taking them out over a 10-year period when Kiefer's working and he's in his highest tax bracket, we're now able to take them out over Kiefer's lifetime, and it's a 7% annual recalculation. Well, what do I mean by recalculation? Well, we take the value of the trust every December 31st and say, what's the value? And if it's $1 million, we're going to say, okay, we're going to take out 7%, $70,000 for the following year. If there's growth in the account and then the $1 million has grown up, then it's going to be a 7% payout for that. And that happens annually, normally in a quarterly situation. People like it quarterly. Now, that's going to last for as long as we set it up, and let's just say we leave it to Kiefer for his lifetime. Then upon Kiefer's death, whatever's left in there may not be anything, but whatever's left in there would go to a charity that you select, or what we call a donor-advised fund. And a donor-advised fund is considered a charity, but it allows your children and your grandchildren, and in this case, it would be Kiefer's children, who would decide, you know, where that money goes every year. So it really is designed to bring philanthropy into the family and pass it on down to generations. Now, those grandkids and great-grandkids don't get to direct the money to themselves or their friends, but they can say, you know, I want it to go to this school, or maybe the symphony, or maybe, the Red Cross or cancer or whatever it may be. So we really like those, and it's becoming more and more favorable and popular. So let's just compare that now, the T-CRUT with the Secure Act. Current value of the IRA, total payments, see it's roughly the same. T-CRUT has more taxes than the Secure or the Stretch, there's no doubt, but less than the Secure, so that's good. At age 85, Kiefer's age 85, there's about $300,000 left in the T-CRUT, so if Kiefer continues to live, he can continue to withdraw 7% of that. Obviously, with the Secure Act, we had to take it out over a 10-year period, so there's nothing left there. You can see that there's about $200,000 or so more with the T-CRUT rather than the Secure Act, and there's another $300,000 left in the T-CRUT that if Kiefer were to die today, that would go to charity, or that would go to the donor advised fund. But if he lived to be 100, it would continue to pay to him. Everyone understand that? Pretty clear? Great. That's a 7% T-CRUT payout. So the next question people ask me is, well, how do you set these things up? Well, the T-CRUT is, the first word is T, and the T means testamentary. So it doesn't really come into existence until you die, until the grantor dies. When you want to set one of these up, the first thing you do is you determine who your beneficiaries are. That's pretty simple. It's usually going to be your kids, unless you have nieces or nephews or whoever it would be. You just can't pick me. And I know you were thinking that, but I'm sorry, you just can't pick me. But you have to determine who your beneficiaries are. And then you determine who your trustees are going to be. Now, normally that's going to be your same person as your executor or executrix of your will. Normally, it's probably also going to be a child. So in Don's situation, Kiefer would be the beneficiary and Kiefer would be the trustee. And then, of course, you want to figure out which IRAs you want to designate. So it's not like you have to do them all. You don't have to do any of them. You can do them all. You have all that option. You can do half and half, whatever you like. So normally you would designate the IRA. Okay, I want this IRA to go into that. And what we would do then is we would change the beneficiary designation on the IRA. After you determine which IRAs you want to designate, then we sign the trust documents. Again, nothing really happens. And then we go in and change the beneficiary designation on the IRAs to be the T-CRUT. So just like, for instance, in Don's IRA, Kiefer is the beneficiary. We would change the beneficiary designation on Don's IRA to be, the Don Sutherland Charitable Remainder Uni-Trust. And then upon Don's death, there would be a check paid to that trust, and it would come in tax-free. And then immediately the same year, we would start making those payments and taking those payments out. So at death, the T-CRUT becomes funded. It's not funded until then, and then a payout begins the same year. So that's the rule. Any questions about that? So pretty simple. Nothing really happens significantly until death. We just go through the process of getting everything set up, and then at the same time we can also set up a donor advised fund and have that sort of there waiting to go. We just did that recently, and I really enjoy this stuff, because essentially what we're doing is we're taking money that would have gone to the IRS, squandered and wasted, all right, and we're leaving that money sort of to your family and your loved ones, but then also to the community and the things that you care about. And I can tell you this from working with so many charities, that the charities are a lot more efficient and responsible with their money, and it's things that you care about. I'm not telling you what to care about. I just know that you do care about things, and I think that directing your money rather to taxes to things that you care about, I think is a great idea. And I can tell you that for my estate, I'll probably leave 100% of my estate to a charitable trust just because I love them, and it's the right thing to do for me. But charitable trusts are not easy. I mean, it's a specialty, and we're not doing divorce work here. We're not doing arbitrations. We're not doing any of that stuff. We're focusing on wills, trusts, and estates. So it takes a team of people to get this stuff done, and that's what the Magellan Group is all about. So, Magellan Legal is the one that does the they do the legal preparation. We create the documents for you. And then we have the tax firm, which is headed up by Henry, and they're very important because we have to do an informational return every year, and we also have to do the calculations every year. So we have to keep up with that 7% or whatever the calculation is going to be every year. There's also something that's very important called 4-tier accounting. And all charitable trusts have 4-tier accounting. It's required, and not every CPA, I think, or tax professional is out there doing that. But we have a lot of experience with it, and we've got it really down to a great system. Finally, Magellan Planning Group, which is the portion where we do the investments. It's important to make sure that our tax characterization is the same. For an IRA, that's not so important because it's going to come out as ordinary income anyway. But we do a lot of charitable remainder trusts that allow us to dispose of a lot of high long-term capital gains. And so when we have a charitable trust, we want to make sure that our tax characterization doesn't change inside of there. So we go from long-term capital gains, which is a lower rate, to ordinary income, which is a higher rate. Technicalities you don't really care about, but it's important that that's done. The other thing that Magellan Planning Group does on that portion is we do the investments. So we make sure that everything is earning money, and we keep a good portion in there to make sure the income stream can be made, and we make sure those checks go out on a quarterly basis or annually if that's what they prefer. So for the trustee, which would be a Kiefer in this case, all he's got to do is just check in with us once a year, check in with us and sign the IRS reporting documents, and then just make sure that we have the ability to send the checks out to everyone. And that's essentially what they need to make sure the investments are going right. And then that's really all they need to do. It's not a burden on them at all. We take care of all of it. And it's for those of you who have worked with us for over the years, that we like to bring all these professionals around the table once a year at least for your benefit. And we're talking about you behind your back. There's no doubt about it. But hey, that's a good thing. And we're usually saying good things. Except, for Earl. No, Earl, I'm just kidding. So then the next question I usually get is, what about the fees? How much does this cost to do? Well, there's legal fees up front. There's no doubt about it. It's a trust. It's an irrevocable trust. It's not funded. So let's just say you did this and you decided you didn't want to do it, you just could toss it. So it's not like it's required. But once you die and it becomes funded, it's irrevocable, and it has its own tax ID number, and it's going to have its own tax form that we have to mail off. The range here is basically whether you're a client or not. If you're just walking off the street, it's $3,500. If you're already a client of ours, we give all of our clients basically a 50% discount on our legal work. With the annual filing, kind of the same thing. That also includes the annual calculation, the 4-tier accounting, all those things that are crucial. Because you do not want the IRS to come snooping in on this stuff, because they'll come around and disallow it or something like that, and you have to go to court to find it. to fight it. And you know, with the IRS, you're guilty until proven innocent. So even if you win, it's a loss because it's not fun. So we've done tons of these, and we really know what we're doing. The investment management their portion for Magellan Planning Group is only 1. And we do that, you know, even for the smallest charitable trusts, which is a significant discount because our normal fee is 1.5, even on say a small $300,000 or $400,000 account. But for these charitable trusts, we're just doing a flat 1%. So because we want to do our part too. We want to do our part to give back to the society as well. And of course, larger accounts of, once we get up to the $3 and $5, $10 million range, that drops significantly. So we can always talk about that. Let's see. That's essentially it, folks. You have learned in roughly just about 20 minutes the value of the T-CRUT and the death of the Stretch IRA and why the Secure Act did that and why the T-CRUT is so great. So with that, if you have any questions, you've got my email address. There it is, kevin@magellanplanning.com. And I'm just going to check to see if we have any questions queued up right now. If anybody has any questions that are open, I don't see any open questions right now. But if you do have questions, shoot me an email. And I hope to see everyone real soon. I want you to be safe, and I'll talk to you soon. Take care. Bye-bye.